Hi students, welcome back to my channel. So in today's session, I am going to discuss internal reconstruction of companies and one of the important and crucial topic in CA Inter Advanced Accounting. And you can expect around 7 to 14 marks from this chapter. And sometimes you have 7 marks bit and sometimes you have a full question for 14 marks. And frequently you have one question from this chapter in the advanced accounting paper. And so don't ignore this topic. And one of the easiest topic and purely depending upon the entries and concept only. And in this lecture, not only the concept, and I'm also going to discuss around seven important questions from the exam point of view. And if you follow that seven questions, and you will get 100% concept over. 100% clarity over internal reconstruction of companies. Okay, and please go through the entire video without any skipping. And if you like the video, don't forget to press the like button and also please share it to your friends so that it will reach more number of students and they will also will get benefit. Okay. And without wasting the time, I will start internal reconstruction of the company. And first of all, reconstruction of company. Nothing but what reorganizing the financial structure of the company. For example, the company is having the huge losses from the last few years. Huge losses. For example, having the profit and loss account debit balance, and some assets are overvalued, and some unnecessary intangible assets are there. For example, from the last 5 6 years, you are that entity is having the huge losses. Then, and shall we have the any goodwill in the market? Means no, and no intangible assets will be maintained. But some intangible assets we have, and some deferred expenditures like discount on issue of shares, and that type of expenditures we have. And by considering that, by reorganizing the overall financial structure of the entity, that is called as what reconstruction. And generally, reconstruction is of two types. One is external reconstruction and another one is internal reconstruction. In case of external reconstruction, a new company is formed to acquire the existing loss-making company. A new company is formed to acquire the existing loss-making company, and the total accounting already we discussed in AS 14, nothing but what amalgamation of company. But coming to the internal reconstruction, without forming the new company, we have to adjust our capital structure, our assets and liabilities internally. Liabilities internally. So nothing but so you need to eliminate any overvaluation of assets are there. First identify, and any in unnecessary intangible assets or unnecessary fictitious assets we have, and try to eliminate that, so that if because of having the overvaluation of assets or unnecessary intangible assets and profit and loss account debit balance, and because of these all things our financial statements are not representing fair presentation. So our financial statements are representing unfair presentation. So that to eliminate, to convert that financial statements into the fair presentation, you need to eliminate these all things. Unnecessary intangible assets required to eliminate, and profit and loss account debit balance, and any assets overvalued, those are required to be reduced. So any unrecorded assets or unrecorded liabilities are there, those required to be identified. And by using these all things, we reorganize the total financial structure of the company and is called as what internal reconstruction. Internal reconstruction. But in case for doing the internal reconstruction, we have to take the permission from the court. But in case of external reconstruction, the court permission is not required. Not required. But external reconstruction topic, so completely covered under amalgamation topic, the same accounting we followed as per AS 14. And here we completely discussed about what internal reconstruction only. Okay. Then, if the company start the program relating to the internal reconstruction, then what are the journal entries to be recorded? And one by one, I will discuss. And first one, relating to the share capital, what are the entries to be recorded? In case of alteration of share capital, like for example, in case of increase in authorized share capital, no, because authorized share capital, Issued share capital, subscribed share capital are not recorded. We recorded only what on the face of the balance sheet we consider paid up share capital. If any change in paid up share capital, then only we give the impact of that item in the books of account. So increase in authorized share capital, no entry is recorded. And the splitting. For example, high denomination, 100 rupee equity share is splitted into 10 equity shares of rupees 10 each. So high denominator share is converted into low denomination share. So in that case, we have to write the entry equity share capital 100 means 1 into 100 to equity share capital 10 each 100 means 10 into 10 rupee share. So high denomination share is converted into low denomination share is called as what splitting. And ulta, low denomination share is converted into the high denomination means 10 equity shares are converted into means in ulta 10 equity shares are converted into 100 rupee equity share 100 rupee. In that case we write the entry equity share capital 10 each account debited to equity share capital 100 each. So 1 into 100. So if high denominator share converted into the low denomination, we call it as splitting. We call it as splitting. If low denomination share is converted into the high denomination, we call it as consolidation of the shares. Call it as consolidation of the shares. Okay. And another sometimes the shares are converted into the stock and stock is then reconverted into the share. When the shares are converted into the stock, we write the entry equity share capital account debited to equity stock account, equity share capital account debited to equity stock. And when the equity stock is reconverted into the equity share, we write the entry equity stock account debited to equity share capital account. Equity stock account debited to equity share capital account. So in case of change in authorized share capital, no entry is recorded. In case of splitting of the share, high denomination to low denomination, we have to write the entry equity share capital account debited to equity share capital. In case of consolidation, low denomination to high denomination, we write the entry equity share capital account debited to equity share capital. If the shares are converted into the equity stock, equity share capital account debited to equity stock. If the equity stock is reconverted into the share capital, equity stock account debited to equity share capital account. And those are the entries to be recorded. And one of the important topic is surrendering of the shares. So surrender shares surrendered. Surrendering of the shares means the shareholders voluntarily surrender their capital to the company, and those surrendered shares are used to pay off the liability holders like debentures or to the creditor. And whatever the shares surrendered are used to be pay off means those shares are allotted to the debenture holders or creditor or other liability holders so that their liability will be decreased. Their liability will be decreased. So, what are the entries to be recorded here? When the shares surrendered, we write the entry. So, then equity share capital has been decreased. So, equity share capital account debited to shares surrendered account. Equity share capital account debited to share surrendered account. If any equity shares are converted into the preference shares, or if any equity shares are reduced, then no entry is recorded. Any conversion will be done, assumed it has done through the share surrendered account only. Then share surrendered to share surrendered, no entry is recorded. When the shares are allotted to the debenture holder, when the shares are allotted to the debenture holder, we allotted the shares out of the share surrender. So we write the entry shares surrender account debited to share capital. You may issue what equity shares or by converting the equity shares into the preferential, you may issue preferential. For converting the equity shares into the preference shares means if any shares are surrendered, those equity shares are converted into the preference shares. Remember, no entry is recorded. And directly we write the entry only when the shares are allotted to the debenture holder or to the creditor. Say, for example, here 10 lakh worth of the shares are surrendered. Out of that, 8 lakh worth of the shares are issued out of the shares surrendered to the debenture holder or to the creditor. When the shares issued, we write the entry this one. Shares surrendered account debited to share capital. But to whom the shares are allotted, their liability will be decreased. The decrease in liability will be transferred to capital reduction account. So remember, capital reduction or capital reconstruction account is nothing but a separate account is opened to record the impacts relating to the internal reconstruction of the company. Internal reconstruction. So, for example, if the shares surrendered or issued to the debenture holder, then we write the entry what? Debentures account debited to capital reduction account. Capital reduction. If the shares are issued to the creditors account debited to capital reduction. To whom that shares are issued, their liability will be decreased. The decrease in liability is transferred to capital reduction. But actually here we surrendered 10 lakh. But out of that 8 lakh only issued. The remaining 2 lakh is there. The 2 lakh amount is transferred to capital reduction or capital reduction. Capital reduction account or capital reconstruction account. What is the entry to be recorded? Share surrendered account debited to capital reconstruction account or capital reduction account. Okay, so when the shares are surrendered, we write the entry equity share capital account debited to shares surrendered, and the shares available in shares surrendered are used to allot the shares to the debenture holders or to the creditors or to the other liability holder. When the shares allotted out of the shares surrendered, we write the entry shares surrendered account debited to share capital account. And to that extent, the liability has been decreased. The decrease in liability is transferred to capital reduction, and any excess balance is there in share surrendered will be transferred to capital reduction or capital reconstruction account. Okay, I hope you understood. And one of the important and crucial topic in internal reconstruction relating to what? Shares surrendered. And next, valuation of variation in rights, shareholders right. For example, previously 10% preference shareholders are there, preference share capital, and now as a part of the internal reconstruction, company decided to issue 9% preference shares to them. In that case, we write the entry 10% preference share capital account debited to 9% preference share capital. Means old preference share capital account debited to new preference share capital. There is a change in dividend rights. Change in dividend rights. Next, reduction of share capital. When the shareholders agree to waive off, for example, 100 rupee share is reduced to 25 rupee, means 75 rupee they waived off, and that 75 rupees transferred to capital reduction. So we write the entry equity share capital account debited 100 to equity share capital 25 to capital reduction account 75. To capital reduction account 75. So when the shareholders agree to waive off their paid up portion, then to the extent of agreed portion of waived off is transferred to capital reduction. So equity share capital account debited to equity share capital to capital reduction, and that is the entry to be recorded. Okay, next. So these are relating to what? Share. And one more point is relating to the shares is nothing but, for example, if the equity shareholders agreed to waive off their rights over reserves and surplus. Their rights over reserves and surplus. Generally, on the liability side, we have share capital, reserves and surplus. On the equity share capital and reserves and surplus, generally who is having the right means equity shareholder. If the equity shareholders agree to waive off their equity share capital, and this is the entry. Equity share capital account debited to equity share capital to the extent of the waived off portion is transferred to capital reduction. For example, if the equity shareholders agreed to waive off their rights over the reserves and surplus, that reduction of reserves and surplus is transferred to capital reduction. Generally, reserves and surplus are having what? Generally, reserves and surplus are having what? Credit balance. So as those are reduced, that is transferred to that account is debited. So reserves and surplus account debited to capital reduction account. Reserves and surplus account debited to capital reduction. This is the entry when the equity shareholder give up their rights over reserves and surplus and accumulated profits of the company, if any, then reserves and surplus account debited to capital reduction. Generally, we didn't have reserves and surplus because we are doing the internal reconstruction only when the company is having the losses. Nothing but profit and loss account debit balance. That's why only reserves we used. So next, settlement of outside liability. If any liabilities has been settled, if any liabilities has been settled, so then we write the entry. So for example, creditors are there. Creditors worth 1 lakh. We settled at 90,000. Then 10,000 reduction is there. That is transferred to capital reduction. And we write the entry what? Creditors account debited to cash or bank to capital reduction account. Credit or account debited to cash or bank to capital reduction. The reduced portion, whatever the waived off provided by the outside liability holder, is transferred to capital reduction. Because the decrease in liability is a profit to us. That's why capital reduction is a credited. Okay. And if any unrecorded liability we settled, if any unrecorded liability we settle, generally in case of unrecorded liability, what we do? First we have to record it. And there is an increase in liability. And the debit is given to what? If anything happened relating to the IRC, that impact should be provided through capital reduction account only. So we write the entry capital reduction account debited to liability. So here we recorded unrecorded liability, we recorded. Then we pay the amount. So liability account debited to cash or bank. Liability account debited to cash or bank. If any unrecorded liability you identified, any unrecorded liability paid, first we have to record the liability, then only we have to pay. Instead of writing these two entries, we can write a single entry, capital reduction account debited to bank. Capital reduction account debited to bank. No need to record for example, if unrecorded liability is there and that liability holder agreed to waive off full, no need to pay any amount to the respected party. Then ignore it. No need to write any entry. 100% waived off is provided. 100% waived off is provided. If anything you paid towards unrecorded liability, simply write the payment entry through capital reduction or capital reconstruction account. Okay. And same way, contingent liability. Contingent liability is nothing but what? Actually, it is recorded below the balance sheet. If contingent liability is recognized as a liability, means just like an unrecorded liability. If any unrecorded liability we pay, what is the entry? Capital reduction account debited to bank. If any contingent liability we paid, capital reduction account debited to bank. Okay, and no need to recognize it again. Next, and this is important. Provision for tax. And in case of provision for taxes, for example, provision for tax is 3 lakh and the amount paid 3 lakh 50,000. And out of the tax paid 3 lakh 50, 3 lakh is the recorded liability and 50,000 is unrecorded liability. Recorded liability, if anything paid, liability account debited to bank. Unrecorded liability, if anything paid, liability is or capital reduction account debited to bank. So here we write the entry provision for tax account debited 3 lakh. Capital reduction account debited 50,000. To bank account 3 lakh 50,000. 3 lakh 50,000. Understood? So provision for tax is around 3 lakh. But amount of tax we paid 3 lakh 50,000. Out of the 3 lakh 50,000, 3 lakh is only recorded. 50,000 is not yet recorded. So 3 lakh is treated as a recorded liability. 50,000 is treated as unrecorded liability. When the amount paid Provision for tax account debited 3 lakh. Capital reduction account debited 50,000. To bank 3 lakh 50,000. For example, provision for tax is 3 lakhs, but amount paid is only 2 lakh. Only 2 lakh. And it means 1 lakh discount is there. 1 lakh reduction is there in liability. Same. Provision for tax account debited 3 lakhs. To bank 2 lakh. To capital reduction 1 lakh. In that case, what is the entry? So, if so, provision for tax is 3 lakh, but amount of tax paid 2 lakh. What is the entry? Provision for tax account debited 3 lakhs. To bank, to capital reduction, how much amount? 1 lakh. To capital reduction, how much amount? 1 lakh. Okay. So this is about what? Provision for tax. Next, this is about liability. If any liability decrease, if any liability paid, liability account debited to bank. If any unrecorded liability paid, capital reduction account debited to bank. Simple entry. Okay. If any liability waived off, then liability account debited to capital reduction account. Okay. Next, assets related adjustment. So in case of overvaluation of assets, we have to decrease it. In case of increase in value, in case of appreciation or increase in value, we have to increase the value of an asset. Then that amount is transferred to capital reduction. Entry is assets account debited to capital reduction account because increase in value of an asset is debited and increase in value of asset is a profit. That's why capital reduction account is credited. Undervalue, there is a decrease or write off of an asset, writing down of an asset. Then decrease in value, then asset should be credited and the debit is given to capital reduction. We write the entry. So capital reduction account debited to assets account. And at last, for example, if any asset has been sold, what is the entry we recorded? Bank account debited to asset account. And any difference is there in asset, that is transferred to capital reduction. And another one, if any unrecorded asset is sold, if any unrecorded asset is sold, so any asset sold, we write the entry what? Bank account debited to asset. And any unrecorded asset sold, we write the entry what? Bank account debited to capital reduction account. Bank account debited to capital reduction account. And the balance in capital reduction. And here, so there is a waive off of capital or share capital or decrease in share capital or decrease in liability or increase in liability or anything. Number of impacts are there relating to assets and liability, and because of some capital reduction account is opened for giving those impact. That capital reduction account is used to write off what? Profit and loss account debit balance and intangible assets if any, and surplus balance is transferred to what? Capital reserve account. So we write the entry capital reduction account debited to profit and loss to capital reserve. And another assets will be written off only if it is stated as a part of the program of IRC. If it is not stated as a part of the program, don't write off any another asset. Only our objective is to reduce profit and loss account debit balance mainly as a part of IRC. Okay, and along with that, one more point is, for example, if any expenses incurred relating to the IRC program and that payment of expense is also recorded through capital reduction, means any expense paid, then we write the entry capital reduction account debited to bank. What is the entry? Capital reduction account debited to bank. For example, if any asset has been lost by theft and any insurance claim received, that insurance claim received is also transferred to capital reduction. Any bad debts recovered is transferred to capital reduction, just like bank account debited to capital reduction account. Bank account debited to capital reduction account. So throughout the IRC program, anything happened will be recorded through the capital reduction account only. If the IRC program is done, then as a part of the balance sheet, at the end of the balance sheet name, you have to use the word under reduced for how many years? 5 years. and reduced. And in case of fixed assets, so amount written off under the scheme of reconstruction must be shown for 5 years. Must be shown for 5 years. These are the disclosure aspects. And this is about what IRC. So whatever the balance is there in capital reduction is used to write off profit and loss account debit balance, and any another intangible assets or any another tangible assets, if anything written off as a part of the program, those are adjusted. Any balance is there will be transferred to capital reserve. Okay. Next. So coming to the problem, pass the journal entries for the following transaction, and just to go through these entries. These entries are enough for doing the IRC problem. Okay. And pass the journal entries here. Conversion of 2 lakh equity share into the stock, and balance has been fully convertible debentures. And what is the entry? So equity share capital, we converted the equity share capital 2 lakhs to equity stock. How much? 1 lakh only. And two, 12% debentures. We issue what? 12% debentures for remaining 1 lakh. Equity share capital account debited to equity stock to 12% debenture. Consolidate 40 lakh fully paid up equity shares of 2.5 each into 10 lakh fully paid up equity shares of 10 each. Then what is the entry? Consolidation means low denomination to high denomination. So equity share capital account debited 2.5 each, 10 lakh, so means sorry, 100 lakhs to equity share capital high denomination 10 each. So 100. 40 lakh fully paid up equity shares of 2.5 each are converted into 10 rupee share of 10 lakh equity share. Subdivision means high denomination to low denomination. Equity share capital account debited to equity share capital. Conversion of 12% preference shares of 5 lakh into 14% preference shares of 3 lakh, and the remaining balance as 12% non-cumulative preference share. Okay, so what is the write the entry? 12% preference share capital account debited 5 lakh. 2. 14% preference share capital 3 lakh, and the remaining 12% non-cumulative preference share capital 2 lakhs. Okay, so 12% preference share capital account debited 5 lakhs, to 14% preference share capital 3 lakh, to 12% non-cumulative preference share capital 2 lakhs. Okay, this is the first one. Then coming to here, and the balance sheet of A and Co is provided, and then coming to the program, and first one, the court approved a scheme of reorganization to take effect on 1/4/2000 X2, whereby the preference shares are right down to 75 each and equity shares to 2 each. What is the preference share capital? So 100 rupee per share. Those are right down to 75, means 25 rupees transferred to capital reduction. 10 rupees right down to 2 rupee. 8 rupees transferred to capital reduction. So what is the entry we have to record? Here, first preference share capital, account debited to preference share capital to capital reduction. 100 rupees share, 75, 25. And equity shares are reduced to 2 rupee each. Then what is the entry? Equity share capital account debited to equity share capital to capital reduction. 10 rupee, 2 rupee, and 8 rupees transferred to capital reduction. And remember, there, the most important, to or buy. For example, if it is a buy, then 8 rupees, so equity share capital, 2 rupees the capital reduction. Okay, next. Of the preferential dividend, which are in arrears for 4 years, 3/4 to be waived, and equity shares of 2 each allotted for the remaining quarter. Remaining quarter means for 1/4. So, first of all, what is the preferential dividend? Here, total 4 lakhs into 6% into 4. Correct? 4 lakhs into 6% into 4 years means 96,000. 3/4 waived and 1/4 paid. What is the 1/4? 24,000 and the remaining 72,000 is waived. So ignore it because preference dividend areas is a unrecorded liability. Unrecorded liability waived off portion. No entry is recorded. Entry is recorded only for 24,000. But 24,000, no cash we paid. We issue the equity share capital. So in case of unrecorded liability, so if anything we settled, we have to write the entry through the capital reduction. So we write the entry capital reduction account debited 24,000 to equity share capital 24,000. That is the one. Okay. And interest payable on debentures to be paid in cash. What is the interest payable here? So 22,500. So we write the entry interest payable account debited to cash or bank because already we paid interest paid interest payable on debentures to be paid in cash. Interest payable account debited to cash or bank. Debenture holders agreed to take over freehold property. First of all, debenture holders claim means they are having the claim over debentures as well as on interest accrued. But interest accrued was stated specifically on the above point. That's why debenture holders claim is restricted only to the debenture. Here, what is the portion of the debentures we have? 3,75,000. So they take over freehold property whose book value 1 lakh at a valuation of 1,20,000 in part repayment of their holding. And first of all, here coming to the freehold property, 1 lakh worth of the book value has been increased to 1,20,000. First, we write the entry what there is increase in value. So freehold property account debited 20,000 increased to capital reduction 20,000 and that was taken by debenture holders. Then we write the entry what debentures account debited to freehold property. So total 3,75,000 they are taken at 1,20,000 and the remaining to provide additional cash of 1,30,000 secured by floating charge on company's assets at an interest rate of 8% per annum. And here they considered it 1,20,000. So they write the entry debentures account debited to freehold property 1,20,000. And additionally, they purchase the additional debentures. So bank account debited to debentures. So how much amount? 1,30,000. How what is the rate of interest here? 8% rate. Bank account debited to 8% rate of interest, 8% debentures. Okay. Next. So first freehold property book value 1 lakh, but they are taken at 1,20,000. There is an increase in freehold property by 20. So first we write the entry freehold property account debited to capital reduction 20. Then we transfer it to debenture holder. So debentures account debited to freehold property 1,20,000. And additionally they pay 1,30,000 to the company. In return they are getting so 8% debentures. So bank account debited to 8% debentures. Okay. Next. And patents and goodwill to be written off will adjust at last any assets or any intangible assets written off will be written at the last. Inventory written off by 65,000 and amount of 68,500 to be provided for bad debts. Nothing but provision for bad debts. So it is also provided through capital reduction. Generally, we write the entry what profit and loss account debited to provision for bad debts account. In this case, the provision is recorded through the capital reduction. So we write the entry capital reduction account debited to provision for bad debts 68,500. Okay. And remaining freehold property given to the debenture holders to be revalued at 3,85,000. So remaining freehold property after giving to the debenture holder. What is the freehold property total amount? 4 lakh 25. Out of the 4 lakh 25, 1 lakh is given to the debenture holder. The remaining how much amount is there? 3 lakh 25,000. And the 3 lakh 25,000 they valued at 3 lakh 87,500. So how much amount increase? 3 lakh 87,500 minus 3 lakh 25,000. 62,500 increase. So they write the entry freehold property account debited to capital reduction 62,500. And investment sold for 1 lakh 40. Investment cost is 55,000. We are sold at profit. So bank account debited 1 lakh 40 to investment 55, and the remaining amount is transferred to capital reduction. Okay, and directors to accept settlement of their loan to 90% of thereof by allotment of equity shares of 2 each, and as to 5% in cash and the balance 5% being waived off. And what is the director's loan here? 1 lakh. Out of that 90%, 90,000 means what? Director's loan account debited 1 lakh. 2. Equity share capital 90,000. 2 rupee equity shares are allotted to the extent of 90%. And 2 cash, 5% accepted in cash. And 2 capital reduction 5,000. 2 capital reduction 5,000. And there were capital commitment of totaling 2 lakh 50. These contracts were cancelled and payment of 5% on contract price as a penalty. We have to pay what penalty because we are cancelling the respected contract. So 2 lakh 50,000 into 5%, 12,500. So for this we write the entry. So capital reduction account debited to cash or bank. So 12,500. And ignore tax on cost of the scheme. And here we have to write off what the balance in capital reduction is used to write off. So capital reduction account debited to patent and goodwill, and to inventory, and balance if any to profit and losses. Any excess balance we have that is transferred to capital reserve account. And for this, better to open the capital reduction account. Better to open what? Capital reduction account. And balance, if any, we transfer to capital reserve. Okay. This is the problem. And balance sheet, I am not discussing here. And just follow the schedule 3. And while writing the heading of the balance sheet, don't forget to write at the end of the balance sheet name under reduced. Under reduced. Okay. So this is the problem. I hope you understood. And problem number 3. Parth Limited had laid down the following terms upon the sanction of reconstruction plan by court. Furniture and fixtures which stood at book value 1 lakh 50 right down to 95,000. And the freehold premises which was valued at 7 lakh showed an appreciation of 55,000. Showed an appreciation of 55,000. So furniture and fixtures are right down to 95. Then we write the entry word. So capital reduction account debited to furniture and fixtures. How much amount is there? 1 lakh 50 minus 95. Nothing but 55,000. And freehold premises are increased by 55. So freehold premises account debited to capital reduction 55,000. Freehold premises account debited to capital reduction 55. Next, plant and machinery showed fall in value of 89,000 to be recorded in the books. There is a decrease in plant and machinery. So we write the entry capital reduction account debited to plant and machinery. How much amount is decreased? 89,000. Investment 2 lakh was brought down to existing market value 1 lakh 5. And there is a decrease in investment. Investment is how much amount decrease? 95,000. And Debenture holders accepted to receive the following in lieu of they present 9% debentures 2,50,000. So to the extent of 2,50,000, 9% debentures account debited 2,50,000. Two cash, so 2,50,000 by 5, nothing but what 50,000, and they took the land and building 72,000, and the remaining unpaid portion as a policy forego. They forego what? Forego means waived off. To capital reduction, and the remaining part they agreed to waive off. Right of the profit and loss account debit balance 70,000 and which had accumulated over the years. In case of any shortfall, balance of reserves and sub balance of general reserve can be utilized to write off the losses under the reconstruction. And we have to open what? Capital reduction account. And first, to furniture and fixtures 55,000, and by freehold property 55,000, and here to plant and machinery 89,000, to investment 95,000, and here by 9% debentures. So 2,50,000 minus 50,000 minus 72,000, nothing but 1,28,000. Here to profit and loss account 70,000. To profit and loss account 70,000. So what is the balance we have? So 55,000 plus 89,000 plus 95,000 plus 70,000 minus 55,000 minus 1,28,000. Still 1,26,000 is required. That 1,26,000 is taken from what? General reserve. 1,26,000. Any shortfall is there to write off these all things. We take it from general reserve. We have that amount, the general reserve, we have the balance of 1,50,000. 1,50,000. And this is the third problem. I hope you understood. Okay. And in this case, this is the important point, settlement of debentures, and this is the new point, the balance of general reserve. If anything is used, if any shortfall is there in capital reduction, and the balance of general reserve can be utilized to write off the losses under reconstruction scheme. Okay. Next, fourth problem. Mercers Platinum Limited has decided to reconstruct the balance sheet since it has accumulated huge losses. Okay, and here coming to the problem, Mr. Shiv is having debentures 8%, 12% debentures. Ganesh is also having. Following reconstruction is happened. Uncalled capital is to be called up in full, and then all shares are converted into equity share. What is the uncalled capital here? So 50 rupee, 40 rupee they paid up, and the remaining 10 rupee is there. They write the entry what? Share final call account debited to equity share capital account 1 lakh into 10, 10 lakhs, and then we receive the amount bank account debited to share final call 10 lakh. And the remaining, after getting that, all the shares mean here two class of shares, 50,000, 1 lakh. 1 lakh 50,000 shares are there. Those are converted into 40 rupee share. Then we write the entry, equity share capital account debited 50 each, to equity share capital 40 each, to capital reduction 10 each. So nothing but 15 lakhs, 1 lakh 50,000 shares into 10, 15 lakh. So here 60 lakhs and here 75 lakhs. Okay. First uncalled capital has been called up in full and receive the amount, and then all the shares are converted into the equity shares of 40 each. And existing shareholders agreed to subscribe in cash and fully paid up equity shares of 40 each, 12 lakh 50, and new shares they purchased. So they write the entry, and bank account debited to share capital 12 lakh 50,000. And trade creditors are given option of either to accept fully paid up equity shares of 40 each for the amount due to them, or to accept 70% of the amount due to them in cash in full settlement. Trade creditors 7 lakh 50,000 accept equity share, and the rest so accept cash, opted cash payment. So total trade creditors are how much? 12 lakh 40,000. Out of that, 7 lakh 50,000 accepted equity part. So what is the entry? Creditors account debited 12 lakh 40,000 to equity share capital 7 lakh 50 to cash. Then, so 12 lakh 40,000 minus 7 lakh 50 into they agreed to pay only 70%, 3 lakh 43. And the remaining is transferred to what? Capital reduction. So 12 lakh 40,000 minus 7 lakh 50 minus 3 lakh 43. 1 lakh 47,000. 1 lakh 47. So 7 lakh 50,000 accepted equity part. Rest accepted only payment in cash. Mr. Shiv agreed to cancel debentures amounting to 2 lakh out of the total debentures due to them. First of all, we need to transfer these to their individual accounts. So 8% debentures account debited, 12% debentures account debited to Mr. Shiv. So what is the entry? So in this case, we have to write the entry relating to the Shiv. So 8% debentures, 10% debentures to Mr. Shiv. So how much amount? 7 lakhs. To Mr. Ganesh. How much amount? 3 lakh. And total 8% debentures, both total 4 lakh, and here 6 lakh. And after that, we have to write the individual entry. Cancel the debentures. So, Shiv account debited 2 debentures. So, 2, sorry, 2 capital reduction, 2 lakhs. And agreed to accept 15% debentures for the balance amount due, and also agreed to subscribe further. And the total 7 lakh, right? So, to 15% debentures 5 lakhs. And again, Mr. Shiv purchased additional debentures to 15% debentures. How much worth they purchased? 1 lakh. Correct. First, transfer their holding to the personal account. 8% debentures account debited, 12% debentures account debited to Mr. Shiv, 7 lakh. 8% debentures account debited, 12% debentures account debited to Mr. Ganesh, 3 lakh. I wrote the combined entry. And after that, Mr. Shiv account debited to capital reduction, 2 lakh, to 15% debentures, 5. They accepted 5 lakh for the balance. And they also agreed to subscribe further shares. Further debentures, 1 lakh. And coming to Mr. Ganesh, agreed to cancel 50,000, and the remaining were accepted 15% debenture. Coming to Ganesh, what? Ganesh account debited 3 lakh, to capital reduction 50,000, to 15% debentures 2 lakh 50,000. They didn't purchase additional debenture. Land and building revalued at 51 lakh 84,000. What is the land and building part? 42 lakh 70,000. So 51 lakh 84,000 minus 42 lakh 70,000. There is an increase in value, 9 lakh 14. We write the entry what? Land and building account debited to capital reduction 9 lakh 14,000. Machinery 7 lakh 20. There is a decrease in machinery. So capital reduction account debited to machinery. Computers 4 lakh. There is a decrease in 1 lakh 20. Capital reduction account debited to computer 1 lakh 20. Stock, so 3 lakh 20, 3 lakh increase. So stock account debited to capital reduction 30,000. Debtors 10% less as they appear in the balance sheet. What is the debtors? 10 lakh 90 into 10%, 1 lakh 9,000. Entry is capital reduction account debited to debtors 1 lakh 9,000. And outstanding expenses fully paid in cash. Outstanding expenses. So outstanding expense account debited to cash 10 lakh 60,000. And goodwill, profit and loss account written off, balance if any is transferred to capital reserve. Then we open the capital reduction account. Then capital reduction account debited to goodwill, to profit and loss account. Any extra balance is there transferred to capital reserve account. Capital reserve account. Understood? And this type of holding is very, very important. Okay. So we need to write the journal entries, and after that we have to prepare balance sheet. These are the entries. Okay. I hope you understood. Next, coming to the fifth problem. Here the balance sheet was given, and this is also the similar problem. First, individual things are provided relating to X holding, Y holding, but along with debentures, they are having the trade payables, balance in trade payable, and equity shares also. Uncalled capital is to be called up in full, and such shares are fully and in full, and such shares and other fully paid up shares converted into equity shares. Same thing. Already we discussed that point. First share final call account debit equity share capital, bank account debit equity share final call. And after that equity share capital account debit to equity share capital 20 to capital reduction rest. Stir X. First transfer X related debt only, nothing but this thing. So what is the X related? 12% debentures and first debentures, 12% second debentures, and trade payables to X account. So 3 lakh, 7 lakh, 2 lakh, 12 lakh. Okay. And X has to cancel 7 lakh total debt. So means X2 capital reduction 7 lakh. And to pay 2 lakh to the company and to receive 14% first debenture. First, so 7 lakh. Then they received cash bank to Mr. X 2 lakhs. And 7 lakh was cancelled out of the total 12 lakh. 7 lakh was cancelled. Remaining 5 lakh is there. Well, extra 2 lakh bank amount is provided. Total 7 lakh is there. For that 7 lakh, they accepted what? 14% debentures. First debentures 7. This is the one. Already total 12 lakh pending. Then 7 lakh was reduced. Total 5 lakh balance is there. 2 lakh more provided to the company. 5 plus 2, 7. For the total balance, they accepted 14% first debenture. Y is to cancel 3 lakh. What is the balance is there in Y? 6 lakh. First we write the entry. 12% first debentures, 12% second debenture, trade payable to Mr. Y, 6 lakh. And Mr. Y account debited to capital reduction, 3 lakh. And Mr. Y account debited to 14% first debenture. The balance is 3 lakh. And capital reduction account is used to write off goodwill. Profit and loss account balance is write off the computer. Don't transfer to capital reserve. Write off the balance if any to the computer. Okay. And we have to open what capital reduction account first. And we need to compute the balance if any, which is used to write off the amount computers. Okay. So this is the similar problem to the previous one. Okay. And here is the next problem. Given below is the balance sheet of Rebuilt Limited. The balance sheet is given and its notes to account was given. Okay. And the equity shares were agreed that their 50 rupee share should be reduced to 2.5 by cancelling 47.5 per share. They also agreed to subscribe 3 new equity shares of 2.5 each for each equity share. What is the entry they recorded? Equity share capital account debited to equity share capital. 50 rupee share is converted into 2.5 to capital reduction 47.5. Well, again they purchased 3 new equity share. Bank account debited to equity share capital. How many shares we have at present? 15,000. 15,000 into 3. 45,000. 45,000 into 2.5. And here I wrote the entry per one share. Each one into 15,000 into these amounts. Okay. And preference shareholders agreed to cancel the arrears of dividend and to accept 50 rupee share, 4 new 5% preference shares of 10 each, and plus 6 new equity shares of 2.5 each, all credited as fully paid up. And first of all, how much is the amount of dividend arrears? Preference dividend arrears is for 5 years. So 6 lakhs into 7%, 42 into 5. 2 lakh 10,000. This is what dividend arrears. 2 lakh 10,000. Then coming to the problem, for 50 rupee share, for every 50 rupee share, they are getting 4 new 5% shares, 6 new equity share. So 2 lakh 10,000 by 50, 4,200. So they are getting what? Capital reduction to preference share 4,200. How many? Preference shares 4, equity shares 6, into 4 into 10, to equity share capital 4,200 into 6 into 2.5. So 4,200 into 4 into 10, 1 lakh 68,000, and 4,200 into 6 into 2.5, 63,000. 63,000 plus 1 lakh 68. 2 lakh. Okay, 1 minute. Four new, total 2 lakh 10 by 50. 4,200 into 4, 4 into 10, 1 lakh 68. 4,200 into 6 into 2.5, 63 plus 1 lakh 68. So 2 lakh 31,000. This is they accepted. Okay. Next, lenders to the company for 1,50,000 have agreed to convert their loan into the share. For this purpose, they will be allotted 12,000 new preference shares of 10 each and 12,000 new equity shares of 2.5 each. So, what is the lenders amount? 5,73,000. 5,73,000. So, what is the entry? They converted 1,50,000 only. So, what is the entry? Loan account debited 1,50,000 to preference share capital 1,20,000, 12,000 into 10 to equity share capital 12,000 into 2.5, 30. 12,000 into 2.5, 30,000. And the directors agreed to subscribe in cash 40,000 new equity share in addition to any shares. So they write the entry bank account debited to equity share capital 40,000 new share, 40,000 into 2.5, so 1 lakh. Okay. Of the cash received by issue of new shares, 2 lakh is to be used to reduce the loan due by the company. So we pay the loan to bank 2 lakhs. And the equity share capital cancelled is to be applied to write off the debit balance in P&L and to write off 35,000 of value of the plant. And any balance is used to write off trademark and goodwill. And what is the entry? Capital reduction account debited to profit and loss account. To plant 35,000. Remaining balance to trademarks and goodwill. To trademarks and goodwill. And first we have to open capital reduction account. Any balance is there and that is adjusted to that and we write the entry. Capital reduction account debited to profit and loss account to plant 35,000 to trademark and goodwill balance effect. Okay. And this is the problem. And coming to the last one, an important one. And this problem is amalgamation and IRC. Amalgamation and IRC. And following is the summary balance sheet of K Limited and L Limited is provided. Here, first, each equity share subdivided into 10 equity shares of 10 each fully paid up. Then we write the entry what? Equity share capital account debited to equity share capital subdivided. 100 rupee share is divided into, so 2000, that means 20 lakh is there. So subdivided into 10 equity shares of 10 each. Each equity share subdivided into 10 equity share, 10 lakh. Out of that, 50% was a rate waived off. So equity share capital account debited to, sorry, shares surrender 10 lakhs. Sorry, shares surrender. Those are surrendered. And preference dividend arrears 3 years. The preference shareholders agreed to waiver of 80% and the remaining accept in cash. What is the preference share capital? 7 lakh. So dividend is 7 lakh into 10%, 3 years. 2 lakh 10,000 is there. 3 years arrears are there, 2 lakh 10,000. But out of that, 2 lakh 10,000, only 20% paid in cash. Remaining 80% waived off. Preference dividend arrears is unrecorded liability. So we have to pay it through capital reduction account debited to bank account. So 2 lakh 10,000 into 20%, 42,000. And remaining amount, we ignore it because unrecorded liability, they waived off. And own debentures, this is very, very important. Own debentures of 80,000 nominal value were sold at 98 rupee come interest, and the remaining own debentures were cancelled. Okay. So coming to here, own debentures and the debenture. This is on what asset side. Own debentures means we purchased it. Investment in own debenture. This is generally available on liabilities. This is generally available at cost price. This is available at nominal value. So what is the own debentures? So 1,92,000 and its nominal value is 2 lakh. And here 80,000 nominal value was given. What is the part? So 80,000 into 1,92,000 by 2 lakhs, 76,800. And the remaining amount, so 1,92,000 minus 76,800, 1,15,200, and that is equal to 1,20,000. This part was cancelled. This part was sold. How many debentures are there? 800, because each debenture value is 100. 800 debentures are sold at, sorry, 800 debentures are sold at 98 rupee come interest. So we write the entry what? Bank account debited. Bank account debited. So 800 into 98, 78,400. But we cancel 76,800, just like in sale of investment. Two own debentures, 76,800. Two capital reduction, 1,600. 1,600 again. The remaining part is cancelled. The remaining part was cancelled. For cancellation, we have to write the entry what? So then, debentures, account debited, 1,20,000, the nominal value. Two own debentures, 1,15,200 to capital reduction. So 1,20,000 minus 1,15,200. 4,800 is transferred to capital reduction. Okay. And here is the entries. 12%. First, we sold this one. Own debentures, account debited. So bank account debited to own debentures, to capital reduction. And 12% debentures, to own debentures, to capital reduction. And these are the entries to be recorded. Okay. And this point is very, very important. And debenture holders of 3 lakh agreed to accept one machinery book value 3 lakh 20,000. So debenture holders accept 3 lakh 20,000 worth of the book value. What is the entry? Debentures account debited 3 lakh. Capital reduction 20,000. Okay. Two machinery 3 lakh 20,000. Okay. So debentures account debited, capital reduction, two machinery account 3 lakh 20. And creditors and debtors stock valued it. There is an increase or decrease in these value we have to consider. And any balance is there first rate of goodwill, discount, and profit and loss account debit balance. So creditors account debited to capital reduction, two debtors, two stock, two goodwill, two discount on issue of share, profit and loss account. And one more point we have here, the company 20,000 as penalty to avoid capital commitment. Penalty any unrecorded liability. So capital reduction account debited to bank 20,000. Balance 5,14,400 is there, is transferred to capital reserve account. And these all points are happened on 1/4/2012. 1/4/2012. And this is what amalgamation part. This is what amalgamation part. And coming to here, equity shareholders of W Limited will give 50 equity shares of 10 each, fully paid up, in exchange of 5 shares held in W Limited. How many shares are there in W Limited? So 15 lakhs by 100 means 15,000. So PC, first we have to, as a part of amalgamation, first we have to calculate PC in terms of equity shares. 15,000 into, for every, we'll give 50 equity shares for every 5 shares. 50 by 5. Each one is 10. So 15,000 into 50 by 5 into 10. How much? 15 lakhs. And preference shares, 10% preference shares of 100 each in the ratio of 4 preference shares for every 5 preference shares. And preference shares are how many? 4 lakhs by 100. 4,000. So preference shares 4,000 into 4 by 5 into 100. 4,000 into 4 by 5 into 100. 3 lakh 20,000. And C, issue 12% debentures of K Limited of for every 12% debenture. This is what payment to the debenture holder not considered as a part of PC. So PC equal to 18 lakh 20,000. We are writing the required to write the journal entries in the books of what? Transferee. There AS 14 is applied. What is the journal entries to be recorded? Business purchase account debited to liquidator of W Limited 18 lakh 20. Then assets account debited, two liabilities account, two business purchase. Difference if any is transferred to capital reserve. If any will be adjusted to capital reserve. And here anything is stated relating to the amalgamation. A scheme of absorption is adopted and nowhere it is stated whether it is a purchase or measure. You may write the entries relating to what? Purchase. So assets account debited, two liabilities account, two business purchase account, two capital reserve or debit side if any balance is there, goodwill. And after that, liquidator of W Limited account debited, two equity share capital, two preference share capital, two equity, two preference share. And next, 12% debentures account debited to 12% debentures account. And these are the entries to be recorded. And after that, we have to prepare the balance sheet. And don't forget to mention here under reduced because it is done as a part of reconstruction on 1st April. So reconstruction is happened on 2nd April. Amalgamation is happened. Okay, here is the PC calculation. Okay, so this is about the internal reconstruction. The last problem is very important. I hope you understood. So this is the end of the chapter internal reconstruction. So the total topic is over 100%. I discussed the concepts and along with that few important questions are also discussed, and don't skip the video. Please go through the video And if you like, please press the like button, and so that it will reach more number of students, and more number of students will be beneficial. And please share it to your friends also. Okay, and don't forget to subscribe my channel. Okay, and next I will start accounting standards, and 2 3 standards will be in one video. I will discuss it in the later sessions. Okay, thank you, take care, bye bye.